We're on the verge of an economic crisis here, folks, that we're not going to be able to avoid. At least that is the way that it seems to be shaping up. And right now everybody's focused on the Middle East and the conflict that is brewing there, but at the same time, nothing has been fixed domestically. So we've got a lot to talk about today. We're going to get into some of the details surrounding the ongoing crisis in the Middle East and how that is likely to play into this economic crisis, which now I believe we have crossed the point of no return. Let's set the stage. What's going on today? We have got the White House telling us that a second aircraft carrier will be sent to the Mediterranean if Israel needs it. So we learned yesterday that the USS Gerald Ford will be deployed to the eastern Mediterranean to potentially intervene to support operations there on behalf of Israel, on the behalf of the United States. Potentially, if Iran gets drawn into this conflict, we'll have a significant amount of firepower present. But now we are learning that a second aircraft carrier, the USS Dwight D. Eisenhower, will be arriving in the Mediterranean soon, and they're going to kind of keep it back, I guess, is the idea. That's the picture that's being painted here, but it's going to be ready to move in for support. And all of this military activity, especially on the part of the U.S., will be contributing to this massive economic crisis, which is right around the corner, if you asked me. Faith Parent, I'm looking at the chat. Someone's saying, what happened to help for Maui? Yeah, exactly. Everybody's attention seems to be completely diverted from all of the other crises, the fires in Maui, the ongoing nascent World War III in Eastern Europe. All of that is now playing second fiddle to what is going on in the Middle East. This is an example of how we don't know exactly how far this conflict is going to spread. So this is from Reuters, last updated 4 hours ago. Israel bombs South Lebanon after Hezbollah rocket fire. And so this is another huge potential event here that just doesn't seem to be getting priced into the markets just yet. I mean, we saw the price of oil coming down today, actually, and yet, we've got these conflicting forces at play here. It seems like the administration in Washington does not want to get Iran drawn into this conflict for understandable reasons. There's an election next year. The price of oil spikes through the stratosphere. That's going to be a real problem for the folks who are in power right now, because inflation will absolutely soar out of control. But at the same time, you have a very bellicose mood from the Israelis, which is I suppose understandable. Again, I try to remain objective in these things, but what else do you expect? You can remember the atmosphere here in the U.S. Following 9/11. Of course, now they are referring to these Hamas attacks this past Saturday as the Israeli 9/11. It was a lot more than just a minor conflict. We saw two massive Middle Eastern wars, the war in Iraq and the war in Afghanistan. War in Afghanistan just wrapped up, of course, just in time for some of those weapons to make their way down to Hamas, of course. And so really, this is almost like an extension of these conflicts if you look at it on a long enough timeline. But should the Hezbollah militias in Lebanon and Syria, should they begin to act in a very significant way against Israel, opening up a second northern front, there's not going to be much option on the part of the United States to intervene in some way. And so even if Iran denies being involved in the planning of the attacks that we witnessed over the weekend, even if the current incumbent president doesn't want to spike the price of oil through the roof, there's still plenty of room for miscalculations. As of the most recent report, those Hezbollah militias, which are funded and trained by Iran in the north there in Syria and Lebanon, they're exchanging fire with Israelis. In fact, some Hezbollah fighters have been killed, some IDF soldiers have been killed. So this is a huge point of potential escalation. And if that happens, expect inflation to just blow through the roof, because the price of crude oil, I mean, you saw some forecasts from, I think, Goldman Sachs earlier was talking about triple digit oil. JP Morgan has had some similar forecasts. Well, we're going to be seeing oil 150 barrels, 200 barrels, or I'm sorry, $200 a barrel, if we see Iran getting drawn into this along with those Hezbollah militias. Iran exports something like 2.2 million barrels of oil per day. Most of it goes to China, but you got to keep in mind that oil is a global market. And so right now, the price of oil is suppressed, or depressed a little. We saw it pull back. There's some news of rising inventories. Well, that will all be used very rapidly in the event of an escalation here. And possibly, even if there are inventories in some places, the ability to transport energy around may be significantly compromised. We just had the Baltic Connector gas pipeline between Estonia and Finland that has been damaged, and now authorities are saying that they're looking at it as sabotage, as it was something intentionally done to damage this pipeline. And NATO is even saying that if it is discovered that there's some kind of evidence that Russia might be involved, it could be even an Article 5 provocation where we might have to respond. Now, I want to do a little housekeeping here real quick. We've got 178 people in the live stream, 42 thumbs up. Huge thank you to everybody who smashed that like button. Do me a favor and smash that like button. Help get this information out there, because this is something that you're not going to hear in the mainstream media. I mean, right now, to be honest, I haven't even been following too much mainstream stuff, with the exception of the news outlets. I haven't had too much time to talk into the talking heads and see what they're babbling about. But I imagine that there's a lot of, war preparations getting out there, getting ready to condition the population for a wider spread conflict. So if you want to get this information out there, that this won't be beneficial for your average American, very well could lead us to an economic collapse and a massive debt crisis, which we're going to get into here in just a moment. Smash the like button for me. Do me a favor. We're at 63. Thank you so much. If we could get 100 thumbs up before the end of this live stream, I would be thrilled. Also, today's video is sponsored by sdbullion.com. Right now, sdbullion.com has an excellent sale. 1 ounce silver coins for $1.99 over spot, any quantity. If you're interested in stacking some silver, some hard assets in light of everything that's going on in the world and the instability, now I think is a good time. Not financial advice, of course, but check them out with the link in the description. If you're a new customer, you can get gold or silver at spot by visiting sdbullion.com/new. Okay, so let's see. We've got a warning coming from the president here, who has assured Benjamin Netanyahu of aid to fight Hamas. Now, as of right now, I would expect that that will mean billions of dollars worth of military equipment. And he also issued a warning to Iran. Now, this is a really harsh threat from our incumbent president. He said, quote, to be careful to Iran. Now, I want to cover something else he said here. So he said, we moved the U.S. carrier fleet to the eastern Mediterranean. We're sending more fighter jets to that region, and made it clear to the Iranians, be careful. U.S. officials say they have not been able to establish a direct link between the Hamas attacks, but are searching to see if they can find one, since Hamas is supported by Tehran. Biden also said that in his fourth phone call with Netanyahu in the 5 days since the Hamas attack took place on Saturday, he assured him that more military aid is on the way. So right now, thank you very much, by the way, Constitutional Stacker, for the super chat, and everybody who supports the channel with super chats. A huge thank you to you. So there's a lot of uncertainty right now about how widespread this conflict is going to become. Now, it's a little bit of a wait and see right now, but the world is a powder keg right now. This is not a surprise. I mean, it's been a powder keg really ever since February of 2022, arguably before that, but especially following the Russian invasion of Ukraine. We've seen a massive wave of deglobalization, of alliances being set. The lines are being drawn for, as Frank says in the chat there, World War III. Yeah, and that's basically what we're facing here. But this regional conflict, it does seem like the fuse has been lit. It hasn't blown up into anything too huge yet, but the pieces are falling into place. But despite all the uncertainty here, you can see that there is one thing that is 100% guaranteed here, and that is that we are going to be funneling vast quantities of borrowed money into this conflict. Biden just requested another $100 billion for the war in Ukraine, but that's just the war in Ukraine. Now, we remember, if we go back to February of 2022, when that conflict was kicking off, you know, everybody kind of thought that it might wrap up shortly. There was a lot of talk of peace talks initially, still raging, by the way. So it's very possible that a year and change down the line, this Middle Eastern conflict could still absolutely be taking place in one way or another, and still siphoning off massive amounts of money. I mean, we saw the last time we got involved in this following 9/11, for example, we were involved in the Middle East for almost 2 decades, or more than 2 decades. And so, yeah, we're going to be facing a multi-front war. And whether or not we get involved directly with the Iranians, I mean, if that happens, it will be an absolute disaster for the economy. You can just expect basically a full economic collapse, I think, in the West, which, you won't hear about. But the problem is that not only will Iranian oil be affected, but you've got the Straits of Hormuz over there. If you saw my interview earlier today with Sean Fu, we talked a little bit about this, but this will be a massive crisis involving a huge spike up in the price of crude oil, an inability to transport it. And, that's just one potential scenario. One thing that we are seeing in this conflict is the energy infrastructure is fair game. Seymour Hersh tells us that the U.S. blew up the Nord Stream 2 pipeline. Who just damaged the Baltic Connector one? That's a big question. Could possibly be something that draws Russia deeper into this conflict with NATO. So there's a lot of moving pieces here. But the one thing that we know that they're already telling us is that we're going to be sending lots of military aid. Now, that's a problem because we don't have a war chest, folks. All we have is $33.5 trillion in debt. And in order to fund these wars to the tune of perhaps another 100 billion for Ukraine, who knows how much for the Israel conflict, could get very expensive indeed, especially if Hezbollah or Iran gets involved in some significant way, which is still looking very possible. This number is going to be moving up very quickly. Now, it's interesting that since this conflict broke out, we've actually seen a decline in the U.S. Treasury yield. So this is the 10-year Treasury, and I'll pull up the 1-month chart here, and you can see the interest rate on the 10-year Treasury was moving up at a pretty good clip before this conflict broke out. We were seeing a huge sell-off in the debt market here in the U.S., and you got to understand, as bonds sell off and their value declines, the yield moves higher. So what we've actually seen is folks buying bonds and driving yields lower since this occurred. Now, there's a couple of things here that we need to look at. One is the safe haven play, right? Folks see war breaking out and they think, well, I've got to get the safest and most liquid asset on the planet, which is U.S. Treasuries. Now, I think that that is a bit of a false beacon of safety, personally. Let me know what you think in the chat. Is a U.S. debt instrument the safest, most liquid asset on the planet? Put a 1 if you agree with that. Put a 2 if you think that, I don't know, something else might be a safe haven, a real safe haven. Put a 2 if you think something other than bonds is the best safe haven. Put a 1 if you think it's debt instruments. But obviously somebody thinks that these are safe because we are seeing the yield coming down on these. But there's a few reasons that this is almost inevitably going to be a trend that reverses, and we are going to see a huge amount of pressure put on the financial system. So one thing I want to take a look at here, and it's something we've examined in the past, but I want to kind of put some stuff together for you here. So look at where this chart goes back to, September 12th or so, and basically straight up since then. So the bonds were being devalued over that time period, okay? Now, let's look at the Debt to the Penny website. And I know I look at this a lot. This is a great site. And, we've been looking at this on recent live streams. If you haven't caught those, I'll give you the quick version. On this date, September 15th, total U.S. debt became over $33 trillion. That's the day we crossed the threshold from 32 trillion to 33, okay? Now, you go to October 5th, that's the day, October 5th, 20 days later, that's the day that we crossed 33.5 trillion. So over a 20-day period, we racked up $500 billion, give or take, in the U.S. national debt, a huge amount of deficit spending. Well, listen, if you are massively expanding the supply of U.S. treasuries by selling them onto the market, then you're going to see the value of them declining and you're going to see the yield keep moving up. You see, as you keep selling these treasuries onto the market as the treasury in order to entice more and more buyers, you have a pool of buyers who will buy at 4%. You got a pool of buyers who will buy at 4.1%. You got a pool of buyers who will buy at 4.2%. And once you exhaust them, if you want to keep selling more debt, you have to keep increasing the rate. Well, now look what's happened over the most recent sessions here, going from October 5th, or we can go to October 6th rather, that's the Friday before all this madness kicked off, 33.51, 33.55. The point is that the rate of borrowing kind of declined here over the past week since this all kicked off. And so, that has something to do with why the yield is beginning to come down. Certainly, that is not enough to bring it down. But what I want to point out is that with all of this, hawkish talk, all of this military aid that's about to begin playing out, we are going to see the debt begin exploding again at a very rapid pace. And when that happens, we are very likely to see the yield on US Treasuries begin to spike up once again as the supply is expanded to cover all of the war spending, which is, again, more or less guaranteed. This conflict could get bigger, it could get smaller. I don't think it's going to get smaller anytime soon. It certainly doesn't seem like the parties involved are listening to calls for de escalation. According to the latest reports, Gaza is under siege. The IDF is planning a land invasion. Now, that is very important because that is potentially a trigger that could cause these Hezbollah militias to go ahead and invade on a northern front should Gaza get leveled, as the IDF is now saying they will be doing. So there's huge potential for escalation. But even if none of that happens, there's still going to be a huge amount of money poured in the form of military aid, and that is going to cause the yield on U.S. Treasuries to continue to move higher. Now, in that vein, with that in mind, with the stage set here, that we may begin to see the yield on U.S. Treasuries resume their upward movement very soon, which, by the way, is, puts a huge amount of pressure on the banks in the U.S. This is a good example of the kind of pressure it puts on them. This is the Bank Term Funding Program chart here from the Federal Reserve, and this represents all of the bonds the banks have had to put up as collateral for these emergency loans from the Federal Reserve. This is a lending facility which, again, when the yield goes up on bonds, the value declines. Banks are sitting on huge portfolios of underperforming bonds that have these huge unrealized losses. Now, depositors come and start trying to pull money out of the banks. They have to sell those bonds. Then they have to realize a loss. This is exactly what triggered the banking crisis and the failure of Silicon Valley Bank and others back in March. Well, if we begin seeing the yields move back up, it's going to be a huge problem for these banks. And I think that is why, despite the fact that at the latest FOMC, we had a fairly hawkish Jerome Powell telling us that there would be another rate hike before the end of the year, look at the CME FedWatch tool for the November Fed meeting. It is a 91.5% forecast that there will not be a hike at that meeting. And in my opinion, I mean, the Fed here is typically in the business of delivering what the markets expect. This tool has been pretty accurate in forecasting Fed decisions over the past several meetings. This is usually correct. And so, if we're going to see potentially higher inflation. That's the other thing I wanted to mention. We just had the producer price index come out today. It's a lot of information here to try to correlate into a cogent narrative here, folks. So sorry if I kind of bounce around. But this is the producer price index. So this, if you take a look here, the important part of this, again, the PPI, what this is a measure of wholesale inflation. So this measures the prices that producers of goods and services get paid for their services and their goods. And this is the chart I want to look at here, the bottom one. This black line is the year over year change in the PPI. And you can see that it kind of bottomed out in June here, and it's actually begun ticking up again. So we're seeing these inflation signals beginning to tick back up in the economy. So if you're starting to see inflation move back up, this is the highest year over year increase in the PPI that we have seen since April of this year. So these are beginning to move back up. The disinflation narrative is toast. It's over. It's not happening anymore. Inflation is not under control. So if that's the case, why is it that the Fed is anticipated to pause again? Well, the reason is because the U.S. banking sector is in shambles, and they know that if they get too frisky here with the rate hikes, they very well could bring this thing to its knees. At least that's my theory. And I think they may be using this conflict in the Middle East as cover for a stealth pause of sorts. Now, if you remember in 2007, before the Great Recession, there was a lot of talk about keeping rates flat. A Fed pause. Actually, it was in 2006 that the Fed stopped hiking rates and they paused, and there was all this talk of a soft landing and everything. And that was actually the last time that we saw the 10-year yield over 4.8%, which it just was over just a few days ago. Since it's come back down a little bit since then. But things are starting to kind of rhyme a little bit with the 2008 financial crisis. The difference is that this time we're a lot more vulnerable because we've got $33.5 trillion in debt and counting. Back in 2007, it was under 10 trillion. So, the systemic problems are much worse. It's like all the problems from 2008, but on steroids that are still in this system. And ultimately, so far, the stock market has kind of liked this conflict. I mean, we've seen a little bit of a rally in stocks. We've seen a little bit of buying in bonds, the yields coming down. But ultimately, the fact that all of this debt is going to have to be monetized and this conflict guarantees a lot more debt, inflation is going to be running out of control. And at the same time, we may see rates going up. It'll probably be a very nasty stagflationary scenario because the thing is, when inflation begins running out of control, that puts upward pressure on rates too, because rates have to compensate for the loss of purchasing power for the dollar. So you can see how we're kind of getting into a situation here. And a lot of it just has to do with the debt, the unfunded liabilities, and the massive defense spending, which we are witnessing before our very eyes. Now, to give you an idea of the kind of impact that this conflict is having on the regional economy, Moody's just downgraded 5 Egyptian banks by one notch. So, right now, Egypt is kind of getting drawn into this. There's the potential for a broader regional conflict. Israel reportedly, according to the Wall Street Journal here, struck a border crossing with Egypt, disrupting the flow of aid. This is what the Wall Street Journal is reporting. Now, there were some other media sources stating that Israel actually had threatened aid convoys from Egypt, telling them not to send aid. I wasn't able to verify that with any, quote unquote mainstream sources. So YouTube, please don't censor me for mentioning that. That was just some stuff that's out there. But it is true. You do have to be careful what you hear these days because misinformation abounds. I've heard reports that there's a lot of footage of the Syrian conflict that's being edited into narratives of what's going on in Gaza, what's going on in Israel, what happened with the Hamas attack. So you have to be very skeptical of all of these reports at this point. But, it's not looking good in the Middle East. And to give you an idea also of how the banking system here in the U.S. is under a tremendous amount of pressure, even though, you're not hearing a lot about it in the mainstream. The war is a nice distraction from the financial crisis which we are facing here in the U.S. All you hear, of course, is everything's great, right? Bidenomics is fixing everything. Bidenomics is the best. Hey, listen, if you don't think Bidenomics is fixing things, please smash the like button because I'm trying to elucidate why the policies of Bidenomics are destroying our financial system. And to be fair, it's not just Bidenomics. I mean, this crisis has been brewing for a while. But if you agree with that, if you agree that Bidenomics is not going to save things, please smash the like button. If I don't see the likes climbing, I will know that you are supporters of Bidenomics. It's kind of a dirty trick on my part. I'm just kind of kidding about that. But oh, look, the likes are climbing. See, I knew we were all on the same page. We're at 144 likes, 376 folks in the live stream. Thank you so much. I see the likes climbing now. That's great. Yeah, if you don't like Bidenomics, smash the like button. All right, so here's the story from CNBC. Now they're really flying up. It's awesome. These regional banks are at risk of being booted from the S&P 500. So, if we were in the best economy of all time, would these stocks be getting delisted from the S&P 500? The problem is that these regional banks, Zions and Comerica, their stock value has been so beat up that they are at risk of no longer meeting the listing requirements of the S&P 500 in terms of their total market capitalization. So that is not a sign, folks, of a strong financial system. In fact, it's a sign that these stocks are going to get delisted and put onto a smaller exchange, and then that is going to be a big problem. They're going to be put into a small cap index is what will happen. And, potentially that could be bad for their share value moving forward. Of course, what's probably worse for their share value is the massive portfolios of bonds with all these unrealized losses that these banks are sitting on. That, of course, is a huge problem. C130 says, has anyone noticed that junk silver is really junk now? I mean, we are down to the bottom of the barrel. Yeah, I know what you mean. You will probably get some very coal quality coins. Although, keep in mind, I don't have any junk silver out here, but they haven't been minting that stuff since 1964. So the fact that you can get your hands on it at all anymore is still, I think, a huge opportunity. I actually recently pulled the trigger on some more half dollars. I like those. So those should be arriving soon. Because here's the thing, gold and silver right now, kind of treading water. Gold and silver are off the lows. I think that they're also catching a little bit of a safe haven bid. But as rates move up on treasuries, we may see the decline further of hard assets like gold and silver and just about every other asset out there, including real estate and stocks, as the yield continues to move up on bonds. And the reason being, again, because we're going to be selling huge amounts of debt and increasing the supply of these treasuries massively. It may cause investors to divest themselves of things like gold and silver. I had a comment the other day. Someone who said that he sold all of his gold and silver. Now, he probably regrets doing that because I think he did it right before the little bit of a recovery rally that we've had. But he was putting it all in a money market account to collect 5% interest. And while I don't necessarily view that as being a particularly wise decision, again, it's not financial advice. I'm not telling you what to do. Everybody's situation is different. I would be very hesitant to sell my gold or silver in exchange for a 5% yield on fiat paper, which is almost guaranteed to be printed ad infinitum as these conflicts continue to increase in cost, and there's no money to fund them. We don't have a war chest. Biden is very comfortable. It's very easy to promise other people's money, especially money that isn't even around. Oh yeah, we just write a check and sell some treasuries onto the market, and that's how the financing for all of these conflicts is going to go. I also read, it's not just, again, the Middle East. You've got to take a look at everything. North Korea right now. North Korea and South Korea have had some kind of a joint military cooperation thing going on since 2018. Of course, not cooperating really. They're still highly at odds. In fact, still just under an armistice. But they had a little bit of softening in relations. Well, the South Korean defense minister, I don't have the story pulled up here, but he just canceled that agreement because he wants to begin monitoring the border with North Korea again, fearing Hamas-style incursions. Now, is that just, alarmism? I'm not so sure about that. I mean, that sounds like the sort of thing that you might wake up and see on the news these days. And as we witnessed over the past weekend, these situations can change very rapidly. And so, keep in mind, you got that border. You've got the South China Sea with Taiwan. You have got Niger and the ECOWAS nations at odds in Africa. These hotspots around the world are magnifying and increasing in their scale. And so it's not just that we're going to be spending billions of dollars in Ukraine. It's not just that we're going to be spending billions of dollars in Israel, although it looks very much like we will. It is that we are going to probably be spending billions of dollars on a multi-front war, which may expand even well beyond this. It could disrupt the global economy in a very significant way. We certainly guaranteed will be printing a lot of money to pay for all of this. And if we don't do that, if we don't run the printing presses, if the Fed doesn't wave the white flag and begin monetizing this debt, we will see the yields on U.S. Treasuries spiking up in a very big way. And that will create a bank failure. Or something else will break. I don't know what it will be. The interest on the U.S. national debt, which it doesn't move up exactly as the rate on the U.S. Treasuries moves up because it takes time for the debt to get rolled over to this higher interest rate. But as yields move up and they remain on this upward trajectory, the interest on the national debt will continue to increase. It's approaching $1 trillion. It is now exceeding the amount that we are expending on defense. And if we continue on this path of massive deficit spending and increasing rates, the interest on the national debt ultimately will become the single biggest expense on the federal budget. If you recall, Janet Yellen told Congress what was it, maybe a year or two ago, that we didn't need to worry about the debt. All we had to worry about was being able to service the debt. And at the time, rates were at record lows. And she said, well, rates are low right now. She didn't seem to understand that rates can move up moving forward, which almost inevitably occurs when you have rates near 0%. Now that we're seeing that happen, the cost to service the debt is increasing tremendously. At the same time, you've got small business bankruptcies booming, tax receipts are down. So this amplifies this problem because the more, even though spending is moving up, the tax receipts are coming down. That's making the deficits even wider. So you have a very toxic mix here. We have increasing debt, increasing rates, increasing inflation. And yet, at the same time, you can still get an ounce of silver for $22. You can get an ounce of gold for, I don't know what a physical ounce costs now. This is 10 grams of gold, by the way. But you can get an ounce of gold for around $1,900. And that's pretty incredible to me because there's going to come a moment when this debt either well, eventually the debt will have to be monetized. Either that or we have a default. And you know how crazy we always get around debt ceiling time. You know, we're always told that the whole world is going to fall apart if we default on the debt. Well, they're not going to let that happen, I don't think. I mean, just look at the rhetoric. They're always trying to keep the can kicked down the road a little bit further, but ultimately, that is going to lead to massive debt monetization on the part of the Federal Reserve. It's going to lead to massive inflation. I mean, that's the only really two outcomes that we can move towards here, unless, I suppose possibly maybe the US government massively cuts entitlements, cuts defense spending, peace reigns around the world, and we pay off the debt the old fashioned way of taxing and paying it down. But I don't know about you. I don't really see that happening. Put a one in the chat if you think that will happen. Put a two if you think it's more likely that we will see a massive inflation. Might not be a hyperinflation. I don't think it counts as hyperinflation if you have like 10, 15% inflation per year. But taken cumulatively over a fairly decent period of time, that can become a huge problem. What was the peak of inflation? It was about just under 10%, I think, last year. And remember, the CPI is highly manipulated, highly massaged. The real inflation rate likely doubled that. And I think that that was just a preview of where we are headed. So, if you want to talk about 15 to 20% inflation annually, is that a hyperinflation? No. Is it an enormous problem for people who are already maxed out their credit cards just buying groceries and paying their bills and who can't afford rent? Yeah, it's a huge problem for them. So expect a number of problems resulting from this foolhardy economic policy of running up massive multi-trillion-dollar debts in a very short period of time. That is the crisis that everyone seems to be ignoring. I mean, it's kind of mystifying to me that you just, do basic mathematics and you look at the pace at which the debt is increasing, and it becomes pretty clear that this is not sustainable in the long term. And yet, everybody just keeps moving along, buying U.S. bonds, thinking everything's going to be fine. We're on the brink of World War III. Everybody's watching reality shows and TikTok. I mean, I guess it does seem to be dawning on some people that we're on the verge of a real problem. But how many of them are getting prepared? How many of them are stacking food? How many of them are stacking gold and silver? How many of them are training and getting prepared for what's coming? Well, not very many, but I hope some of you are, because the more of us who are prepared for what is coming, the better we will be able to weather this storm. And it's not going to be the end of the world, but times are going to get pretty tough. We could see a financial crisis, the likes of which we haven't witnessed in living memory. There's a few folks maybe who remember the Depression these days, but they're getting pretty few and far between. And, that I think is what we may be headed towards. So I'd be very interested to get your take on this. Leave me a comment down below to let me know your thoughts. Thank you all very much for tuning in this evening, and I will catch you next time. Stay safe and happy stacking, everybody. Smart Silver Stacker, out.